Hello, and welcome to Read the Bull. I'm your host, Stefan and today I'm joined by a very special guest, Lee Munson. He is founder, president, and CIO of Portfolio LLC. I've known Lee for quite some time. Lee, welcome.
Thanks for having me. This is going to be fun.
Yeah, it's going to be a lot of fun. So we're going to talk a lot about your book, which you wrote a long time ago. I'm going to hold it up here. I have a.
Is that like that's like a digital blockchain chain, like crypto version of the book?
Exactly. I bought an NFT of your book.
It's an NFT.
This was from 2011. So, on this podcast, we're going to be talking to authors who've written books that have recently been published and books like yours that have been published a long time ago. So 11 years ago, your book's almost a teenager.
My wife I mentioned to her that you wrote a book a long time ago, and I was just in shock because the pain of writing that book.
Yeah.
Because I didn't ghostwrite it. The pain of it is still it's still here.
Yeah, I bet. Yeah.
It's
and
recent.
I want to talk about that pain, but I want to start first, and we're going to talk about why you wrote the book. But I just reread it because it had been a little time, and I went back and I read it. And the first thing after taking furiously a lot of notes, the first thing that was my reaction was this book is still very relevant today, which may be a good thing, maybe a bad thing. So I want to talk a lot about, again, your role as an RIA. And I should say you're based in Albuquerque, New Mexico, correct?
Yeah, so I basically serve most of northern New Mexico. So Albuquerque, Santa Fe, Taos, and then Los Alamos. I have a large following that comes from the.
But you have clients all over the country as well.
Yeah, I would say about 70% are in the state of New Mexico, and about 30% are nationally based. All over the place. Nothing really outside the U.S. A few people outside the U.S., but mostly it's U.S.-based people.
Okay. So it's dense with information. And I think it's such a great book in terms of you're trying to educate. It is a little bit self-help, but it is a book about the Wall Street game and a lot of explanation. And you do a great job about explaining the history and context of a lot of these strategies and how they came to be. And, I don't know too many books that just have packed so much that give readers a real sense of, how we got here. And I was just, really impressed with how much it stood up, again, which is a good thing, a bad thing. I want to talk about how much you think Wall Street and has evolved in terms of advice and just, selling products, to the retail crowd. But I feel like a lot's changed and nothing's changed. So I wanted to just start, and I don't know the last time you've cracked open your old book, but what do you think? And again, I should just say it covers, strategies it talks about, we're going to talk about 60-40, but you talk about ETFs and, mutual funds and the evolution of index funds and ETFs, and you get into all that, and you talk about different strategies people use. And again, you give a great explanation of, what they're supposed to do and how we got there and how Wall Street tries to sell them to people. But just overall, I don't know if you've looked at it recently. Is there anything you think that needs to be updated, or you're like, oh, I got that wrong? Or
Yeah. I think that I didn't have a healthy enough respect for how much ETFs are going to overtake everything and what the costs, what the real implications are going to be. I have a different view of the concept of indexing and what indexing is and what it's supposed to mean. And that's a thing that's evolved over the past 10 years since 11 years since I wrote the book. I went from a world where, I'd have a few mutual fund managers here or there, but I was mostly buying individual securities, doing my thing. Or I was using ETFs in my risk budgeting modeling and stuff like that. I think if you would have told me that, in 2022, ETFs are going to dominate markets and open-end mutual fund, it's just going to get worse and worse and worse. I would believe you, but I still think that on the flip side, we still have a slowness of adopting that. I still get clients that come from other advisors, and I look at the portfolios and like, oh my God, this is so 2005.
Yeah.
Like, who's running this? And so I think that's the main thing. We found that there were certain strategies that were related to mine as far as like risk parity strategies that have blown up over the past couple years. And I think that was a long time coming. I would love to write more about the great regime change and the end of the bond bull market. We're talking about the end of the bond bull market in 11. And it didn't really end. It didn't end until, I mean, it's true when you're early or wrong, but that went on for another 10 years. We had the longest run in history go on another 30% of that duration in time, moving forward in time for another 10 years. So I think that that's the thing that was most interesting looking back at the book, is that we continue to have that bond bull run for another 11 years, that we had really got with a jobless recovery for years. Things like the Phillips curve, for instance, which shows the connection between inflation and unemployment, that type of thing, that got thrown out the window. We found that you could stimulate the economy with over $1 trillion and recapitalize banks and do all this and not get inflation. And I think those are the things that I have been most surprised at over, since I wrote the book, and also how pronounced we had over the past 10 years, especially since 2016, of just no growth in the world. All those predictions about sort of Japanification of global markets and the lack of growth, those all did come true, but everybody didn't sell their stock funds to buy bond funds. Your boomer is still very much invested in stock markets because of this low rate environment. The idea of that low rate environment continuing, which is crazy. And we look back and it makes sense now, right? So I think those are the things, I didn't know in 2011 it was going to take another 10 years for a regime change. And I think that that's the problem with predictions. But ironically, everything that people said 10 years ago did happen, but the effects of it are not what people thought, as usual.
Yes. And we have been incentivized to keep buying stocks in this low rate environment. Obviously, that's changing a little bit. So we'll talk about that. Yeah, a little bit. But you get into this whole description of what people, you don't tell people what to do in the book, which I like, but you kind of show people how they should look at things. And I think that's really impactful because you talk about risk and how people just don't, they need to come up with a plan, number one. And not be seduced by all the noise and everything being sold to them on Wall Street, because they're all
which is always about reducing risk, right? Because nobody ever comes with a high risk investment and say this is very risky, right? Wall Street, every bear market brings up the selling of magic beans, meaning I can sell you return with no risk. And every time you get a hot market, the idea is that there is no risk at all in the markets, that we're only going up, right? And so Wall Street, what I've learned in the past 11, 12 years is that Wall Street is getting even better at obfuscating and sort of hiding, keeping hidden really where the risk is, and convincing people that there's always a lower risk way to, in some way, shape, or form, get to your goal. And I would say that that's, by the time it's packaged, marketed, and ready to move out to the masses, whatever that was no longer exists, right?
Reading the book is like being inside your head, which is very scary on one level, but very interesting because you pack so much in there. And I want to talk a little bit about some of the evolution in terms of some of these products, because I think that was really helpful. You talk about, because again, I think Wall Street, sells us a lot of things, but in some ways, some of this financial innovation, in some ways is supposed to make things cheaper and more accessible for a retail audience.
But
that comes with a cost. And I think
so. Let me summarize that, because I think that that's such a key point. Trading costs. Let's use bond funds, for example. That is the big space right now. I'm so excited about being an investor now that we have bond regime, because I have more and more choices. Literally just this month, I have 6 more choices on how to slice and dice bonds and do certain things like that. It's the technology that came out of algorithmic trading and the technology that came out of dark pools, which I talked about. Nobody talks about dark pools now, but 12 years ago, dark pools were a real topic of conversation. Right. It was a real interesting thing, and people don't think about going into their discount broker now and trading, and they don't think about that never sees an exchange. Right. We were just getting into that new world back when I wrote that book. It was still new and scary, and people didn't know what to think about it. Well, what do we know now? What to think about it was that all of a sudden we're not going to be able to pay for a trade anymore. We get our trades for free as long as we let some algorithm front run us a little bit, right? And so that's an interesting dynamic. But I think that it's still a net win for the average retail investor, because they can access things at lower cost. So I might have bond portfolios, like bond ETFs, just as an example, same thing as Stockline, where your cost might have been 50, 60 basis points in expenses, and now it's down to 3 basis points. Mm-hmm. And your ability to take a group of junk bonds, and because of the technology and the innovation, you can have dealers trade instead of individual issues. They can just recirculate entire complicated portfolio baskets, kind of like we started doing in the 80s with the S&P, these cash baskets, right? But we're doing that in bond land now, which is to me the ultimate frontier. And that's allowing me to access certain markets that prior to this were rather illiquid and was the big boy thing, right? Like once it was time, if you just wanted to buy cash S&P, you had to buy futures. And then you say, well, now I can buy SPY, now I can buy the spider, right? And then you could buy sectors, and now you can buy everything. Now the downside is we create too many new innovations. Right. And so so for instance, there's a company, I'll not name them because I really love them, even though I'm going to sort of, give a backhanded compliment here. They're a new bond ETF provider that will provide me, say, CCC or B rated bonds, right? This is a real garbage. This is like, you better know what you're doing when you're going into this area. But such an elegant way to get that at a reasonable price without a lot of friction. And so that's useful to me. And they also did some ones where you can buy a 6-month treasury, not like a Vanguard where it's 1 to 3 years, but like, I just want 2-year treasuries. I just want this one thing, and I want to be able to move it without calling a dealer. That's wonderful. But then they also give you 8 different sector junk bonds, right? Like a little too narrow, a little too gimmicky, a little too like, do you really need to be doing that? Because if you're that sophisticated, you need to be running a credit fund. We're getting a little too far off. Yeah. And of course, the prices on those things too far off are always much higher. Why? Because people like me don't have a desire for the gimmicking of innovation. And so you can always point to the gimmick, and it's like, how do you know? Well, because this cost 8 times more than the core thing that caught my attention. Yeah. The core thing might be 3 basis points, 8 basis points, but then the stupid thing might be 40 or 50 basis points. Like, because you're providing sucker bets. It's like a craps table. Everybody who plays craps knows it's the best odds. It's the back bet on a 6 or 8. Right. Come on, it's just math. But then it's like, well, then why do they have a hard 8? It's like, well, it's craps because people can't do that. The hard 8 bet, just so you know, the hard 8 means that you want to get 2 4s, right? Yep. And if you get any other type of 8, you lose your money immediately. And if you get a 7, you lose your money immediately. So, and the payout is not that good, right? But it feels good when you hit it. Yeah. And that's what's happening in Wall Street. It's a craps table where your standard good bets are known by people like me for years. The odds get better and better and better. The cost, the innovation, it gets better and better and better. But then we're not getting rid of the dumb bets. Right. And that's okay as long as you understand that as a consumer. Because if we don't have those dumb bets, how am I going to get this wonderful, like if it wasn't for the dumbasses doing hard 8 bets, how is a casino supposed to give me good odds on a back bet on a 6-8? The answer is they won't, and they may not be able to, right? Yeah. They may not be able to subsidize quality innovation if they don't sell crap. And the other thing is, if you're in the business of selling ETFs, you want to sell things to you want to sell what people want to buy.
Yeah, so let's finish that point, because you talk about, again, this is a time when ETFs were just coming into vogue, and you said, yeah, they can be good, but we don't need an ETF for everything.
Yeah, I still believe that. That's the one thing that I said back then, that it's like, oh, I was wiser than I knew. We're still there. There's still only 10 ETFs that you know. Now, of course, I just got through saying, oh, there's all these new bond things, and I can say, but I only need like a couple of them, right?
And they have to serve a purpose. And that's
and I just think that they're getting more refined of what I want, right? But I was talking to a client buddy of mine who's a journalist and a great writer, and he was doing a story on thematic ETFs, and he was showing me some ETF, and it was like a breakfast ETF. And I was like, what? And I looked at it, and it was just like commodities. You know, some ETF provider paid an index fund, because they're all just whores for the money. It's true. And they're like, oh, pay us thousands and thousands of dollars, and we'll create the XYZ breakfast commodity index. And it's basically just like soft commodities, you know, like orange juice. It's just soft. It's soft commodities, which I think that the ticker to cover, I think it's like DBA or something, you know, like I'm sure there's somebody who says it's not DBA, it's DBC, but we already have a commodity index that you can buy an ETF, but it just takes out cotton and like soybeans or something. And then it's like everything else. It's like, we needed a separate ETF for that. It's like, well, this is a breakfast. You know, breakfast is never going to go out of style. And Americans love breakfast. It's like, are you kidding me? Are you kidding me?
And you also talk, and you also talk about how they're also, again, selling this myth that, you know, they just capture everything. I think in the book you talk about the energy ETF, and how there was an overexposure. I forget to which company, but if you took out one company, and it was like 30-40%.
Exactly. It's not diversified. You know, you'll look at certain indices now in sectors, you know, you might see, you know, Amazon at 15% of something, or, I mean, you know, I think that you could even turn it to something a little bit more simple of looking at the NASDAQ 100 and finding that there's only a few companies that make up 40% of it. And do you really want that exposure? Sometimes you do. Right. And so I'm more open to having something like that has a huge exposure to something. But what you're really doing is you're just saying, I want to buy some crazy thing over here, but I want to hide that fact from clients. And so I'm going to buy this ETF that's really driven by something without actually having to say it. That's a problem. Right. But I think that, you know, as long as you know that going into it.
Right. You know? And that's, I think, again, the underlying part of the book is to just help people try to understand what they're looking at, ask questions. You brought up this analogy to the casino. So I do want to talk about, because I'm going to read you a line, because I thought, again, very relevant still today. You talk about options. Yeah. And we know, obviously, options, you know, for the past couple of years have been kind of front and center for the retail crowd.
I can't believe that options have exploded in popularity. I mean, it's just...
So this is what you wrote in 2011. Crazy. I find that Wall Street is very focused on getting people excited about options and their trading capabilities, but in the end, wants the end user to make up his or her own mind. That was in 2011. So now we know what happened over the past couple of years with options, and it seems to only have gotten worse. Right. And so what do you think?
And we didn't know why. You know, the thing that I didn't know in 2011 was how it was going to get worse. Right. We know why. We didn't know that you're going to have.
Well, give me the why real quick.
The gamification, things like Robinhood, where people can get a stimulus check, pop a little money in, and trade a single contract and just do it on their phone without really fully understanding what the option contract is for. And also the proliferation of weekly expiration options, right, that go every week. Because, you know, back in the day, you'd have, you know, 10 to 12 months of expirations. It wasn't always every month. And now I was recently looking at, you know, selling some short puts. It's like, yes, I still do that from time to time. And it was just like, well, I just want October. And there's like 3 or 4 October, like, it's like, oh, do you want October 3rd or the October 10th or the October? It's just like, We can't, it's like option, like October expiration. And it's like this thing over to the side. It's like, oh yeah, like that, like back in the old days, like you had once a month, you had like, and then sometimes there's a triple witching. And so, and that's because options don't trade free on commission. Those aren't free commission trades.
Right.
And so you say, well, we're going to give the commission free for, domestically listed, securities and ETFs. And then, but they said, but if you really want to like make the real money, buy options, because then all the dealers are making spreads, and brokerage firms love this, right? I mean, why wouldn't they? They're in the business. That's how they make money. They got to make money somehow. I think that we had unintended consequences because a lot of times you're trading more options than you have shares in existence, and it becomes overblown. It's a speculative thing, and you just have a bunch of people who just don't understand it. And when you have a COVID low and everything's going to go up for 6 months, everybody's a genius, everybody's leveraged. I think that it's a problem. The other problem that happens is that because there's such a proliferation of it, you mostly have a bunch of speculators who are armchair speculators, and then there's not necessarily people like me on the other side of the transaction. It's the dealers themselves. And so what happens is the dealers can get stuck losing a lot of money dealing just with one type of client, which is this long and not wrong, right?
Yeah.
And it creates a vicious cycle. And so it's not a plus for the industry. It's a negative. It's better when everybody has different opinions about things.
Yeah.
Right? It's a problem when you get a group, especially in option markets where you get a group that's a singular direction. It's like being a bookie and everybody wants to bet on the same horse.
Yeah.
And that's great if that horse loses, but if that horse wins, that bookie could go out of business. Right. And so, and what happens is when things like that happen, the pricing becomes not as advantageous for the next speculator who's buying the next contract, because the dealers have to ensure that they can stay in business. So it kind of ruins the market in a certain extent. But I think I've really gotten away from options. I think that they're overrated. I think they're priced off. I think that they're great for short-term trading.
Yeah, they can hedge and control risk. That was the original purpose for that.
And I think that they can. I just think that you can control risk better knowing what you're doing and moving around your 60-40 pie chart and doing things like running a more diversified portfolio and selling bonds and buying stock when the crap hits the fan, and vice versa when things move away, and really sort of take a longer term perspective. And I think that's a point of view, and I think that's something that options can't really deal with. I think there's nothing beats hard work, and nothing beats buying dips and buying cheap. I think the problem is that most investors, until they get 50,000 hours of doing this, or like I've been doing this for 25 years, right? I think until you're a couple decades into it, you don't realize, and I think I didn't fully realize when I wrote that in my 30s, that big declines in markets are normal, are good. You should expect them, and you should stop trying to predict them. You should think about how to respond to a market versus react. Because when you're trying to react, then you start using derivatives and options to second guess and to neutralize what you think is going to happen, and you waste a lot of time and money. There's reasons why you might use them, but my reasons are getting less and less. I think you just have to understand that I've taken trips around the world. I was in Bali, and before that I was in India, and I love that Eastern concept that the light and the dark are both necessary components to your day, to your year, to your life, and that we should embrace market volatility and engage it versus trying to figure out how to sidestep it and figure out when to sidestep it, and just say, let it come and you'll see how I act in it. And then when you come out of it, the hard part is selling into that and not enjoying everybody else's enthusiasm, which brings me back to what I think is one of the greatest quotes ever about investing, was from Charlie Munger, Warren Buffett's sidekick. And he said, to paraphrase, the worst part of investing is watching your neighbor get rich. I think that the best part of investing is watching your neighbor lose it all. And once you can get into that mindset, I think that you'll do better. So then, and then every time you hear a GOAT, a greatest of all time, like a Grantham, Perma Bear, or Ray Dalio, he's a billionaire. Does it, start talking, like their permanent stock market's going to decline 40%. It's like, that sounds great. I hope that happens. I could buy everything cheap, right? Because all those guys are still long,
Right. There's a lot of noise out there, and I don't want to talk about that. But I like the discussion about dividend stocks because you talk about how you first understood them or how your dad explained them to you at like 6 years old.
Yeah,
gave an understanding, and he talked to you like you weren't 6, and he explained dividends and how companies make money and give some, to shareholders.
Right.
But as you said, dividend stocks, are, people get a little bit dependent on them because, they've received a great dividend for a number of years. And you compare it to how people, back in the day were just used to the buy and hold strategy.
That's right.
And now people don't want buy and hold, but they look for those dividend stocks because they pay nice, healthy dividends. So where's kind of that balance? And, where do you think dividend stocks kind of stand today in today's market?
Well, I think that what you have to think about is that if you're at a time where inflation is going to be over 3% and money has a cost, you want to think about dividends as if you're in the right areas and if you're in these value-oriented areas where you're paying a reasonable price for earnings or paying a cheap price for earnings. It's in the eye of the beholder. If you look for certain qualities, those types of companies tend to pay dividends. Why do they tend to pay dividends? Because they're larger, more mature companies. They don't they grow slower. So if they get $10, they may only be able to invest 3 or 4 of it and make more profit. They'd be like, if we invest all 10, we're going to be investing in things that don't give us a return above, our cost of capital. Right.
Yeah.
And so I think that it's important to remember that dividends are this nice thing that you will get if you're looking at the right stuff at the right time, which is a market with a cost of capital above, 2 or 3%, and you have inflation above 2%. What I've really learned in my career is that if inflation is under 2% and Fed funds rate is 0, you should just buy growth stocks that don't make money. You should just go buy biotech stocks that will never make a profit, and given a long enough time, will all go to 0.
Yeah,
it's the crap. That's not my style, but that's really the best answer. So dividend stocks are best when you're in a bearish market where there's more inflation or you're coming out of recession and it's part of your total return. But the other problem is that people get stuck and they get enamored. They think a dividend. There's no dividend that's ever been safe in the history of the world, and people will buy based on dividends. I remember in 08, 09, people said, "Well, I'm buying for dividend. I'm not buying for. I'm just buying this company because the dividend yield is higher than the Fed fund rate." But now we have inflation, right? So it's a little bit of problem. So I think people just need to remember that don't buy a company based on its dividend. The dividend, at best, is a indication that management can't reinvest the profits that they make. That should be a warning to you, first of all. Why? Why is IBM paying a 5% dividend? Because they can't find some place to reinvest the money. Whereas Amazon, they don't pay tax because all they do is reinvest all the money. And so you got to figure out, how does this fit into the market structure? Right? Yeah. Are these the type of companies I want to buy? The problem is people will look for high dividends and they don't ask how they get paid. There's a time where ExxonMobil was really dodgy because it's like they were paying dividends that they really weren't making. Now that's completely different, right? But they still hit a 25-year low, a 20-year low during COVID before that realization hit, right? And who cares what dividend you're getting if you're seeing not making money for the past 20 years? And and that means that if you're doing it right, you're probably not going to have the highest dividend yielders in the universe, because those high dividend yielders, there's something wrong with the firm. I like dividends, but if everything I own stopped paying a dividend, that doesn't necessarily change. I've warmed up to buybacks. I used to think buybacks were the worst thing in the world back in 11, and that would have been the tertiary chapter on the sins of buybacks. And I think over the years, I've realized that that was a false cause, and that I think buybacks are fine. I think they help support a market when you're in a low growth environment. So I think I was wrong about that. I'm glad I didn't do the chapter on buybacks and that got cut, so I don't have to look stupid today.
Well, like I said, the book, it was a little bit like a history book. Like, I didn't know the oldest company traded on the NYSE was Sotheby's, but that was really interesting. You give a lot of great background and context to understand how we got, to 2008 with all the bank deregulation and the separation of, with the repealing of the Glass-Steagall Act. And obviously you weren't a fan of that because it led to, again, so much financial innovation, which led to a lot more products that were pushed upon and a lot of the banks taking all the risk. And we know what happened. But it really is a snapshot of all these strategies and how, a little bit of the history about it. We talked about options. I didn't know that options were around for thousands of years. So you have all this great history and it really helps you understand. But, at the core of it, you want to get people to really just ask, the right questions. And I think, your point is with all the financial news that comes at you, there's more information, which is great, but it's also distracts you. But I want to get into why you wrote the book and kind of your evolution, because, as people will read in the book and, they see you on CNBC and Fox Business and a bunch of other places. You've had a little bit of evolution. You started as a stockbroker. So just give me like a quick snapshot in terms of your evolution in the business, because as we learned at the top, you're out in Albuquerque, New Mexico, not exactly, known for,
the financial center of the world.
Financial sector, but you're doing great things out there. So just give a quick snapshot of how you kind of came, into the industry and how you ended up out there.
So I started my career on Wall Street. I'd always been I grew up with a dad who had retired very young, and he owned a lot of, income producing real estate and speculated with stocks and bonds. His dad, my grandfather, he was paralyzed from the neck down and was a paraplegic from 1954 on in a car crash, sold the family feed farm, the feedlot, and became a full-time bond trader. And this is like in the 50s. Yeah. And so I grew up in an environment where, grandpa would, my dad grew up under the shadow of a man who would wake up in the morning and the nurse would bring him a phone in, to his ear and hold it since he was paralyzed from the neck down. And a stockbroker from Merrill Lynch in San Francisco would read him the ticker tape. That's a shadow to live under, right? Yeah. And then I got to live under the shadow of that kid, right? Yeah. And I think I had a similar upbringing where you have a dad, and it's like after a certain point in my life, he doesn't go to work every day. He trades and he works markets. And trading was very different back then. Sure. The holding period was longer. You weren't doing day trading. I got into the business in the late 90s. I became a stockbroker, a licensed Series 7 stockbroker at a place called Prime Charter, which was the best place in the history of the world to be in the late 90s in New York. Yeah. It was full of scoundrels and con artists and some of the best telephone sales people that you've never heard of. They taught me everything I know. Prime Charter, we sort of lovingly call it Crime Charter, was ironically not criminal. It was not made up.
Not a Stratton Oakmont.
But we had people that came from Stratton Oakmont who worked at Prime Charter. So I actually were, and I don't want to say their names to out them, but I've told you that I still have, the infamous, we call it the Lehman Brothers Black Book, where it has all these pitches. Yeah. And it's like, they go back to the 70s and stuff. And,
do you remember specific pitches?
Oh God, yes. Chrysler of asking the client to buy all 1 million shares of Chrysler. Like, we're going to buy Chrysler and all this stuff, and just how to position yourself. And just crap, how to lie about it. Says, oh yes, it's sort of like, I'll get you, I'm just off, I got to leave today in my Jaguar, my E-Type gunmetal gray. And it was important that you said gunmetal gray because people thought, oh, that really meant you're a serious guy. It's like, okay. So it got into the psychology of investors and what makes people click, which is greed. And then there's the 4-letter word for greed, and that's fear.
Yeah.
Fear is just a 4-letter word for greed. And so you play off of both of those, and that's really what you learned. But then what you come to realize is that that's what markets run on as well. They run on trust, a handshake, gaining the confidence and trust of somebody, and then they run on emotions and fear and greed. And so it really wasn't a bad education. They also taught me what not to do.
Yeah.
I had a great time. I had good mentors. I still keep in contact with them today. It was really my best years in New York and the most fun in the business. But all good things come to an end. The neat part was you had a lot of people that came from the seedier side of the world. And because Netscape had gone public, you had these .com stocks. So you didn't need to do dodgy stuff to find a stock to go from 10 to 50. So everybody could just do legitimate business.
Yeah.
Right? Nobody needed to be on the edge anymore because Wall Street was on the edge. And so I learned the street smarts and sensibilities of a few interesting, colorful characters. But I was safe harbored because of when I got to Wall Street. There wasn't a necessity, and it had gone out of style to do dodgy micro IPOs. Nobody wanted to waste their time on that stuff. Yeah. People wanted to buy stuff that had a buy rating from Merrill Lynch, right?
Sure.
Like this is like it's sort of like we went legit. And so I came in kind of after that period. And then from there I went to Bear Stearns because I thought that I was too good for it all, which was a big mistake. I mean, I wouldn't have changed that life decision now. I went to Bear for a short time, 6 months or so. Just it did not work out. Depressed day one. I realized that a bigger firm doesn't really have better ideas. Mm-hmm. I realized that there is this fallacy of what we call bench depth. They're like, oh, you're at Bear Stearns. There's all these people. Yeah, please. It's just a bunch of people doing their own thing, and nobody's like, there's no working with each other. It's just a bunch of BS. It's like, oh, we have all these different departments. Yeah, none of which are going to help you. Everybody's just an island unto themselves. And that's where I realized that Wall Street really is a lonely place. Yeah. You really are just you and your wits. And all this idea about committees and teams and all this stuff, that's a big lie, right?
Yeah.
That's just something that salespeople say, right? Yeah. Because they're just part of these big teams distributing and selling stuff. But in the end, things work best when there's a single despotic leader, a monarch, a person, because you have to have the sanctity of your own mind. So then fast forward, 9/11 happens. So sad. I leave the city. I get depressed. I come out to New Mexico, start my new life.
But that was kind of a moment. Before
it was a moment.
It was a moment. And I want to get to this in a minute. You had kind of talked about New York being, you were quoted in an article, which we'll talk about, but you're saying, saying that it was like being in Rome at the start of fall Rome. And then months later, 9/11 happened. And that was kind of a moment for you.
It was, because when you're a young, brash kid saying provocative things from the heart, and then it becomes actualized in the real world, it doesn't make you feel prophetic.
Yeah.
It makes you feel depressed, scared, because you're calling it right. And you're saying these things to kind of like crap on the situation that you put yourself in. But then when it turns out to be true, it's a problem because it's not going to be easily solved. And that the excess that you were talking about, these structural problems that we're brewing, it's true. And I think the worst part is I wasn't running a hedge fund to profit from it, right? I'm just saying, oh, this is good. And then it does. Like, why did I set up a trade for that, right?
So you go out to Mexico. Why did you choose New Mexico?
It was the furthest place mentally from New York that there is on the map, right? I mean, it's the place where people go to hide out and escape. It's where Billy the Kid spent his time, right? It's where Georgia O'Keeffe decided, this is where I want to paint for the rest of my life. It's where Garrett Thornburg back in the early 80s said, I'm out of Bear Stearns. I'm going to go out and start a money management firm in Santa Fe, New Mexico. Yeah. And everybody thought he had lost his mind.
Right.
Sure, he lost his mind just as much as I lost my mind. But then you find happiness out here. I did it because I went to school out here at St. John's in Santa Fe. Right. My wife's down in Las Cruces. And to me, it was safe harbor, where I could figure out what I wanted to do for the rest of my life. which unfortunately was to be in the business and run money. And it was a place where, the cost of living was relatively cheap. It was different back then. Albuquerque was smaller. I got a gig at the Charles Schwab company, running their private client, their advice offering, which was new to them. The idea of sales, sort of like called the S word. And I remember my first day was April 1st, 2002.
Yeah.
Which is just funny because the article was on April 1st, 2001. Their intranet was talking about how they were going to talk about the S word and sales and how it's okay to sell. It was this cultural shift. And I was kind of like, they're like, is this a joke? It's like, no, and we've hired Lee Munson, right? It's sort of like I came the first day when it's like the butt of jokes. Sale, we can say sale now. It's serving your clients. It's called sales, and it's okay to say it. And we just brought this new guy in here that's going to ruin everybody's life at the branch. So that's what happened. So I did that for a while.
Yeah. How quickly did you, right? And then you kind of had this, you had a little bit of awakening coming out there, but then you had an awakening about serving clients, and obviously the experience of Schwab contributed to that.
I needed to do more.
How Wall Street is just trying to sell you stuff, and you were like, no, I want to serve my clients.
I want to do that. And you have to be, and I realized you have to be in an independent situation to do that, and Schwab had a big institutional department where you got to see how there was this whole group of people who had decided to go be independent advisors, RIAs, as we call them in the business. And you could focus on a niche business. For me, that was important. You could, you don't have to have whatever the company assigns to you client-wise. You could really build your own type of client that you're looking for, and the type of people that you wanted to work for, and the type of work that you wanted to do. And so that was a big influence on me, being able to see that at Schwab and being able to see the institutional side and see the success people are having doing that, and just the personal success and happiness people were. And I mean that in a real heartfelt way. But I was able to start my own firm. I started, January 1st, 2008, which I now realize was not a great time. It took me years to realize why people always looked at me like, oh, I'm sorry about that. And I was like, what? Everything was just fine. There's nothing wrong with starting. Clearly, I had chips on my shoulder that I was subconscious and like not aware of that. But it was great to start a brand new business. I had a baby on the way. I was dealing with a contract dispute with my prior employer. I was dealing with a horrible market. I was in Albuquerque, New Mexico, trying to find multimillionaires, right? Yeah. And now that's not actually that hard, but back then it was a little bit more difficult, right? And I've definitely have done well being fixated on the baby boomer wave and that retirement wave and long-term trends. And so I think that your luck in the industry also has to do with my early success had to do with being at the right place, the right time. Yeah. My longer-term success is Warren Buffett's not the voting machine, it's the weighing machine, right? That's really been about identifying a long-term trend that's just, it's going to happen, and just being there, set up for it, and having the patience to have that play out. I think a lot of people in the industry, they don't have any patience. They want something immediately. What I had to do is I had to give up my delusions of grandeur and just find happiness out here. And then I would say, several years after I kind of swore off who I thought I was going to be, then I became everybody I wanted to be, and now, I'm literally still married, for over 25 years. So, it worked out, but I tell people I have been doing this for 25 years. It's not exactly like,
well, you got a little bit of the gray to show it. So
I do. One bad trade at a time.
I gotta tell you, anytime I see you on CNBC, I'm always looking at your hairstyle. But
that's my trademark.
Yeah, but let me talk about. So this is a podcast about books, obviously. Yeah, I'm talking a lot about your book. I want to talk about how it got published, because it really came out of the response to this article. We mentioned it a little bit.
Right. The infamous New York Observer article. Yeah.
By George Gurley. I don't want to give him too much of a platform here, but the headline was 25-year-old broker Lee Munson is a swaggering relic of the boom. This was 2001. And, I think, look, you've owned, you're 25 years old in New York. And again, it was the go-go days of the 90s. You were a stockbroker.
I'm impressed that I had so much swagger at 25.
Yeah. And then there was a Business Insider article that will celebrate the anniversary of this article. But how did this lead to the publication or the idea of writing this book? Because it was kind of a bit about setting the record straight.
It is. Why does somebody write a book when they're in their 30s? What do they have to say at that point? I had a lot to say. I had a long, what seemed at the time, a long storied career on the street, making a lot of mistakes and having a lot of success too, right? And I sometimes make the mistake. I forget about my successes, right? Yeah. And that's why I'm successful, because all I do is dwell on the failures and try to improve and learn and do all those things. I don't really think about the success. But I think that I wanted to explain to people, especially in the introduction in the book, that bad PR, doing things to goof on people or to paint people in a negative light it takes two people to do that. It takes the subject and it takes the writer, the journalist. And I wanted attention at the time because I was upset and depressed about working at Bear Stearns. I didn't, everybody around me was very proud of me. They thought that I'd made it to the big leagues. And it was hard for me to articulate that I was miserable and that they knew nothing and that I was better off at my old firm where we actually had ideas and we were here to make money, rather that be like just short the market if it's going down, just a pragmatic read on it. And at Bear, that really wasn't it. And Bear, I remember managing director says, "You're here to resell Bear Stearns research." And I was like, I'd never heard that before.
Yeah.
But really, that's the basis of all stock brokering. You're there to sell the firm's research. But at my other place, we didn't have really our own research. It's like, well, just find if there's a buy, if somebody on the street has a buy rec, then you can recommend it. Right. So it's basically saying, just do your own research, but don't buy anything unless there's at least one analyst who has a buy. Well, it's the 90s. There's no sells on anything. So it's like, so basically any stock I want. Right. Yeah. Getting back to the observer thing, I felt I wanted to put down the body of knowledge and all the things that I had learned and all the innovations and thoughts that I'd had up until that point. I thought they were relevant. They're certainly relevant after the great financial crisis. And the other thing I wanted to kind of convey to people through my stories in the narrative was that you're not going to get anywhere in your career unless you screw up. And it's preferable to screw up when you are younger.
Yeah.
Do you want some goody two-shoe that's never screwed up who's 50 because it's like, now you want to happen? Now you want them to learn a life lesson? And it always boggles my mind when you read about people who really fall from grace on Wall Street, who are in their 50s and are very successful. It's like, why were like, take it from me, screw up when you're 25, like you'll get over it, like very quickly. I'm 47. I forget about it. Sometimes I forget that I was like, like you wake up the next day after that and your mugshot's on page 6 in the New York Post. And you're like, well, I always want to be on page 6. And then you realize,
hey, you don't make it. A lot of people, yeah.
A lot of people say you haven't made it in New York till you're in the New York Post on page 6. The problem is that the vast majority of time you're on page 6 is not flattering. And I wish that there was something like, this is before smartphones. This is really before the internet has proliferated. And what was unique about my situation is that they just started archiving things on the Observer. So, if I'd done it a year before, it would have been in print and gone the next day. It's just, mine just stuck around. And nobody at the time, nobody thought, everybody said, oh, in a week, all those papers will be in the trash. Everybody's going to forget in a week. And then there's this thing called the internet.
Yeah.
So it lasted for years.
Still find it. I'm not going to.
Right. It is. Look, it's the 10-year thing was great because we had 10 years later.
Right.
And I was horrified when I woke up on April 1st, 2011, whatever, 10 years afterwards. But the interesting thing, it was a very nice, a nicely written article about there was this guy, Lee Munson, who had this sort of embarrassing devil may care interview and a sort of a drunken night out on the town with his desk partners from Bear Stearns' best friend, George. This was not a guy that I sought out to do an interview with. This was the best
Someone introduced
friend.
you to. Right.
Yeah, he was the best buddy of my desk partner. And so it was this dude's buddy, his drinking buddy. And so we went out multiple times. It wasn't like one evening, multiple times. And we thought we were going to write a screenplay or something. And I was just depressed and I just wanted something creative. Let me give kids advice. Don't. Learn an instrument. Get an anonymous Twitter handle and say provocative things anonymously, but don't actually do it like Lee Munson did.
Yeah. So unfortunately, it's still out there. Yeah,
it's still out there. But now it's kind of funny because the 10-year after referendum in Business Insider, Henry Blodgett, I love you, buddy. It was flattering because it said this guy did this thing, but then he went on to become a success. He went on to have his own firm. He's on CNBC. He's a well-respected market commentator, and that was great because I looked at it and it took me a few days to really internalize it because at first I'm horrified that it's like, oh, don't talk about the past. But then you realize the past is part of who I am.
Yeah.
Right.
Full disclosure, I helped on the PR of the book and I think we leveraged that a bit to help a little bit.
Yeah.
But so when you pitched the idea, who's the agent or how'd you get the idea?
Wiley is a publisher. I was doing, I had some guy who had a public access TV show out in Chattanooga. And he had seen me on CNBC and he says, oh, I'm doing a little regional show on the regional public access. Would you like to come on? I did some work with him. It was fun because we would have all the time in the world. We just kibitz and talk markets and whatever. And he said, have you ever wanted to write a book? I said, I have. I really would love to write a book. And he said, let me help you with it. And so he just knew an agent, which just means you just know somebody's name. And it was a young gal over at Wiley. We got a meeting. And I think I just showed up to the first thing. And
did you get an agent or did you just go directly to the editor?
Oh, I just went directly to the editor.
Okay, so you didn't.
I do everything. No. And by the way, I don't have a PR person who books me on CNBC or Fox Business. I'm just my own. I'm my own free. For full disclosure, the only PR agent I've ever hired was you for the book, which was well worth it. Just because who's going to be my agent? Who could keep up? And I'm too crazy.
It'd be a full-time job.
It would never work.
Right.
It would be me, not them. And so what you do is you pitch them and say, oh, David McGee. Oh my God, that man. And it's sort of and so he had this little access show that was on, and it was on some cable channel that nobody watched. Sort of shows old Gunsmoke reruns in the middle of the night. But he had some thing on cable, right?
Yeah.
And so we pitched them and said, because here's what they want to know. How are you going to move the books?
Right.
We said, oh, we're going to do all this product placement on Dave McGee show. We're going to do Lee's on CNBC. He's on TV. He does interviews. He's done all this stuff.
They want you to have a platform.
They want you to have a platform. So we lied, obviously, because I don't have an agent. I don't know if it's okay to do a little make-believe. And we pitched them the idea that this little cable channel was going to drive sales in some way. Yeah. And that my tweeting and all this social media, there wasn't really, and this is 2011, remember, 2010. So we said that through TV and all this stuff, we're going to really be able to move the books. And that's what they wanted to know.
Right.
And then they wanted to make sure that I was charismatic and all that stuff. And that guy did help. He taught me to get higher rights on international. He said they'll give it to you, which was great because we sold the book to China and I kept all that money. And I was like, well, that's a nice check. That's kind of cool. Always remember, international rights, ask for 100%. Why? Because they don't care until it's a good book. And then the Chinese want to buy the rights to it. And then you're like, oh, that money is mine now. Ha 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 ha. But you need more than just that in selling a book. They want to see the platform. They want to know how many books you're going to buy. If you do lectures or do book tours, they're sort of how many books are you going to buy initially on the first run, either as giveaways to clients or sell what we call in the back of the house during lecture series. And I was doing a lot of media. I want to do more lecture series where I could talk about my work and then have a product to sell in the back. That's what got them to do it. And I was charming and I had the right topic at the right time.
Yeah.
And you helped me by showing them that book Aftershock, how successful that had been. And so here's the thing, you take a shot.
Also a spate of books about kind of the industry, obviously post global financial crisis.
Right.
People are like, what happened? How did we get here? So it was a little bit tapping into.
And also we had just gotten through we were still putting people in jail from .com. .com was still on everybody's mind. It was still there. So I think that with publishing a book, a lot of it had to do with timing.
Yeah.
You have to have the book for the time. You have a great book, but if it's not the time for that book, nobody cares. Right. You had to have a book that everybody in the room reasonably believed that people are going to want to read. Yeah. Like, beating Wall Street at its own game. That doesn't really resonate today, but I tell you, post-Great Financial Crisis, that was relevant probably until 2015. People were still pissed. We're still mad at all those Wall Street bankers.
And again, I think it is still relevant in a lot of ways because,
of course,
you talk about the next greatest scam. I'm not saying crypto is a scam, but certainly I think the way
there's always the next
sold. Yeah. Right. Yeah. There's always the next.
I own a little Bitcoin and it is a scam. It is a scam because it's not real. That doesn't mean you can't trade it, own it, or do things with it, but it's about circumventing hard work and determination. It's about circumventing what capital is about. It's about going to a marketplace, raising money so that industry can grow, create new jobs, and create more crap so that we can all buy it. Because humans are the ultimate Ponzi scheme and the ultimate virus upon this earth. And so capital helps propagate that. I'm not trying to be judgy. I'm just saying that is the original purpose. First principles, as Ray Dalio would say. So let's go back to, so when you're not in first principles, it's the next new bubble scam thing.
Yes. So a couple of things is I want to.
Did I have an agent? You're hilarious.
Yeah. Well, how long did the book take you to write, and what was the most surprising part of the publishing process?
Okay, so here's the thing. I wrote it in 6 months. That guy I mentioned before, I don't want to keep saying his name because he's a jerk. He said he was going to help me write it. And so that's what gave me the confidence to do it. Because he's like, you're going to pay me money and we're going to talk and hang out. And, we're going to have beers and smoke some joints. And we're going to get in here. We're going to write, I'm going to help you write this book and organize, do all these things for you. And then he falls off the face of the earth. I'm high and dry. Yeah. Right. In more ways than one, and I have to write this thing. And so Wiley's all like, we get you all these ghostwriters, it's going to make it easy. And I'm like, why would I write a book that I didn't write? Right. And I didn't realize all those financial books they say your name and with, and there's another with John Doe. Like I didn't realize at night, and then they're like 95% of all business books, they're ghostwritten. I'm like, what? That was shocking. I didn't know this until like 3 months into it when I had to deliver this thing in a matter of months. And they're like, what do you mean you don't have a ghostwriter? It's like, it never dawned on me that you wouldn't write your own book. I mean, I went to St. John's College. I studied the great books. You write your own stuff. It seems cheating. Dude, I would just go up into the mountains, up into the Taos, and just spend my weekends in Earthships, right? Which is, you should Google it. These handmade, weird garbage made, Adobe abodes up in Taos. And I would rent these places a weekend at a time. And I would write 10,000 words a week. Yeah. And you do that for a few months and you have a book. And it was phenomenal because I could just go any place I want and just go to the moon and back. And so I had a great local team. I owe them a lot. No professionals outside of Wiley and the agent. So no ghostwriter, no professional editor. We ended up using Wiley's art director people for the cover. I mean, I don't know. The first couple covers, you're just like, are you serious? But then they had the one with the dart. And I said, that looks great. And I turned it in on time. I got some money for it. We actually sold a number of books. Yeah. I hit my quota or the amount of books. It did not become a big seller in the way that I wanted it to. Yeah. Did it sell more books than other people who I secretly were jealous of or hated at the time. But the book long term was a phenomenal success for my business. I did get business out of it. I did cover the cost of it.
And
I still
that's a
get
reason,
checks. I still get checks from Wiley every year. They're small.
How
They're
much?
just,
Enough to buy a cup of coffee?
oh yeah,
Okay.
enough to buy multiple beers, enough to buy like lift tickets in Taos. That is not
Okay.
cheap.
So I
But
want to end a little bit. I want to end because what I loved about the book is you didn't give everyone like that ending where it's like, here's how you think about Wall Street. You gave all the lessons, but you gave a reading list. What I noticed about a lot of financial books too is, people talk about the books they read because there are just these mainstays. Do you remember what was on your reading list?
Oh yeah, it's the same, memorized because it's my same.
Is it the same? Any additions?
It's the same. Yeah. Same books. Don't change. The Money Game by Adam Smith.
Okay.
1969. It was written under a pseudonym. This guy Goodman, who later went on as Adam Smith's Money World, he wrote a collection of books. I wanted to write a modern version of The Money Game, which is saying like, I want to write a modern version of a Shakespearean play. I mean, it's like, well, good luck to you. Like you just like, it's like, if you can be 10% as inspiring, it will be an achievement of a lifetime. Yeah. And so I think that that's the most critical book. I think you have to read, and because first of all, if somebody says what book professionally, what book represents you, your sensibility, who you are as a market operator, it's like The Money Game, period. Front to back, read it backwards every single day, read it every year. Number two, Reflections of a Stock Operator, which is widely considered, ghostwritten by, it is really Jesse Livermore, who was the greatest trader of the first half of the last century, but was clearly had some sort of bipolar condition, committed suicide in his early 60s. Jesse Livermore's son killed himself. Jesse Livermore's grandkid killed himself. The moral of the story is sometimes people you think are the greatest whatever are mentally ill, and that mental illness drives them to do things otherworldly. And you have to be cognizant of wanting to emulate people too much, because we don't know about what's going on in these people's brains as much as we think we do, right?
Yeah.
I also think Pitbull by Buzzy Schwartz is an excellent kind of deep dive in what it takes. All the Market Wizard books, every single one, front to back, read it backwards, forwards, all of that.
So, any new additions? Any new books that you would add, or anything that's really, you think is worthwhile?
I'm looking at my hutch to new books that I would add.
If not, that's all right.
because
you have a great reading list, and I encourage everyone to read.
I think you just need to read my book and read that reading list. I think all the great books on markets were written prior to 1990.
Okay.
I think all the great books, as far as I'm concerned, were written in the 1960s. I don't know if Battle for Investment Survival was on my reading list, but that was written in the 50s, and that's a must read. Was When to Sell by Justin Mamis.
I have to look at the list.
If When to Sell was written, I think in the 70s by Justin Mamis, that was who Helene Meisler, of course, one of the great technical analysts of all time. I read her stuff and communicate with her all the time. That was who trained Helene Meisler. You got to read When to Sell by Justin Mamis because it's the classic book on technical analysis. And I think that the thing is just people just need to read more.
Yeah.
They need to read more books. And even if you're not reading my reading list, read a reading list. I think that if I could put addendums, I would say I hope it's on here, every single shareholder report from Berkshire Hathaway, written by Warren Buffett, I now consider that more indispensable than I did even 10 years ago. So every shareholder report, annual report. And I also think that indispensable today is all of Howard Marks' memos that he writes, his market memos. And I think Howard Marks is really becoming, to me, the great thought leader of our industry as he ages. I think that he's it. I think Ray Dalio is helpful for practice management and Ray Dalio's principles. Yeah. They're kind of like, it's sort of a cult of it. It's great if you're in the business and you need help thinking about things like, do I need to be honest with myself on how my performance is? Do I need to be honest about, do I really know something? I think Dalio, as a thought leader in principles, really pressed that point. Even though it's cult-like what he does, I think it's like, I follow that stuff. And then Howard Marks' memos. I mean, Howard Marks' memos, front, back, read them 3 times and read all of them over the past, 10, 15 years. And I think that that's what I would add to my reading list at this point.
All right. Lee, I want to thank you so much. Lee Munson, CIO, founder and president, Portfolio LLC. Thank you. And that's your time on Read the Bull.